for her take on the top market movers, including the effect that the soaring U.S. dollar is having on these results. And we got the Fed with a statement tomorrow. Diana Avigdor, she's Vice President, Portfolio Manager, and Head of Trading at Barometer Capital Management. She is at the TSX. Good morning, Diana. Well, they are taking them out one by one, it seems, and shooting them. Let's talk about this reaction to these numbers this morning from some of the biggest companies in the world.
Good morning, Francis. Well, I think as traders, we should all have our heads down today and just read reports and try to sort of make sense of the earnings. We should not trade today because it's going to be a little painful as we're feeling it pre-open already. With Caterpillar, such large caps, trading down so much, the indices are certainly being dragged down, with Caterpillar down 8% pre-open and Microsoft down 5 or 6% pre-open. Let's not forget that there is also more senior traders are not at their desks today. So from a trading perspective, there will not be much support. And despite the fact that there is some real issues as it relates to the earnings today, there's going to be even less support as a lot of people are not going to step in the first real sell-off resulting from the earnings. It's not unexpected, but it's sort of the fears that have been expecting, such as the FX impacts, are sort of coming to the front. Almost every single company that reported today cited FX as an issue. So it's almost like the fear of what you expected is coming through. It is not unexpected, so the market will have to absorb that. From our perspective, Brett models have still held up, even through the central bank tantrum of last couple of weeks. However, we will have to see the next couple of weeks with correlations where they're going to be in terms of what the earnings are bringing. We'll see what the market's breadth and how much of this is going to be absorbed in terms of support.
I'm glad you mentioned the forced holiday for some traders in New York and all up, of course, the Eastern Seaboard. Let's talk about the Fed if we can tomorrow. We're seeing the 30-year U.S. T-bond trading pretty much at record low yields. The bond market, the 10-year yield off 6 basis points. You talked about the central bank tantrums. Are we going to see a tantrum out of the Fed tomorrow?
No, I don't think we see anything out of the Fed tomorrow. There is no press conference either. I think the expectations is for next Yellen talk at the end of February. But there are 3 issues here that are challenging for the Fed. One is global yields are dragging U.S. yields lower. 2, growth may not be as great as was previously expected, and we may have some temperamental data coming forward, especially with some layoffs that have been announced. And 3, the QE out of Europe may crowd out some investors, yield investors, into the one place that is actually working. And despite the fact that yields are so low, you have a currency that is supporting your investment. So that is all dragging yields lower. Well, we're going to see what the economic data is coming out. The economic data in terms of employment is sort of worrisome, as some of these companies, large companies, financials, eBay, there was some chatter yesterday, IBM, that would be laying off some people. So 2 steps forward, 1 step back. Let's just hope it's 1. For now, we also have, this is really important, trillions of dollars in fixed income investments are trading at negative yields. That money is being pushed out into equity markets potentially, and maybe they're not looking for growth. Maybe that money is looking for yield, but perhaps that is what is supporting the breadth statistics that we're seeing. So yields are being pulled down lower for many reasons.
2 issues. I want to talk more about the jobs, which I understand worry you, but just on that yield point, because I know you've been looking at the Canadian banks, which there has been a lot of pressure on. People domestically had been selling them, but internationally as well. But if you're looking for yield, it seems like a pretty safe bet, the Canadian banks.
I agree with you. The charts and the price action, it's not that we're technical, but we do look at the price action to support an investment. It's just how we work. But you're right, the charts are not so great, but yield support is there. With the rate cut out of Bank of Canada, if their banks do not follow suit, that will support their margins. It will support the housing market, which has been a bit of a worry. The energy softness has been a worry for the Canadian banks in terms of their exposure. That doesn't go away, but at current yields, we only have a few banks. There's not much competition. They're raising their fees. They're getting a lot of money that way. So they're in a pretty good situation. There's not much competition to take away what they're able to do in the market.
And actually, Diane, I just saw a highlight that Bank of Montreal is buying in some stock, so they're attracted to their own stock as well.
Yeah.
We'll talk jobs another time. Thanks very much for joining us this morning. Have a good trading day.
Thank you very much. Thanks for having me.
Diane Avigdor is a Vice President, Portfolio Manager, and Head of Trading at Barometer Capital Management.